This is Horizon's Middle East and Africa, our top stories this morning. Deal or no deal, it doesn't matter. President Trump says he's sticking with the July 9th deadline for trade talks, while threatening Japan with higher levies in a dispute over rice. And Fed Chair Jay Powell's also talking tariffs, saying the Fed probably would have cut rates further this year were it not for Trump's trade policy. And Trump says Israel has accepted the conditions needed for a 60-day ceasefire in Gaza, warning Hamas to agree to the deal. Those are your headlines this morning. It's just gone 8 a.m. across the Emirates. Welcome to Wednesday, and we are a week away from that self-imposed tariff deadline, which, as I say, Trump is not extending. You've got traders tired of these escalations, these tariff headlines, and the US stock rally losing steam yesterday. But look at the futures picture here, pointing higher on both sides of the Atlantic, moderately. But if we also look over to your bond space as well in the cross-asset picture, not so much movement here, even though you have seen the big, beautiful bill passing through the Senate. Now it heads back to the House and the focus returns to the US economy. Of course, we've got that jobs report tomorrow. Maybe we'll get further gains when it comes to treasuries on the expectation of Fed cut bets. That's been powering gold higher for 2 days. We're higher again today at $3,339 a troy ounce, just a touch higher. Brent's hovering around $67 a barrel, but there's a lot of geopolitical headlines to digest when it comes to Iran and Gaza. And as we look ahead to that potential supply hike out of OPEC Plus on Sunday, we're going to get into all of that later in the programme. For now, let's take a look at how Asian markets are faring now that Donald Trump's revived his tariff threat. And with that is Avril Hong in Singapore. Hey, Avril.
Hey, Lizzie. Yeah, we are seeing Trump reviving that tariff threat, also saying there won't be an extension of that deadline, coming along with a cautious-sounding Powell, really not helpful backdrop for Asia stocks that are in retreat for the most part today. Trump also signaled and singled out Japan, citing this gulf in U.S.-Japan trade negotiations and the lack of progress on talks. So Japan stocks are extending declines from yesterday. It's also worth noting that even if we see some form of trade deals, most think that the baseline 10% tariff rate is there to stay. So this puts export-reliant economies in the region also on the back foot, and a troubling backdrop for stocks in the region overall. I just quickly mention when it comes to the greenback volatility, it's also put the Hong Kong dollar in the spotlight. We saw it touch the weak end of the permitted trading range. The HKMA has stepped up defense of the peg, and it's intervened in the form of buying up about $2.6 billion worth of local currency. Lizzie.
OK, so a different reaction in Asia to the US futures picture, Avril. Really interesting. Let's dive into this now. President Trump, as I say, sticking with this July 9th tariff deadline while renewing his threat to cut off talks and slap further duties on various nations, including Japan. Joining us now with the latest is our senior editor, Bill Ferries. Bill, Japan seems to have gone from near the front of the queue for deals to the back of the queue. Is this just more of Trump's escalate to de-escalate rhetoric?
Yeah, I don't think we know at this point whether this is just a negotiating strategy to try to get a few more concessions from Japan, or if the president at this point is so frustrated he doesn't really care to hear anymore and is set on maybe implementing a unilateral tariff on Japan. Regardless, Tokyo, I think, finds itself in the position that most countries would like to avoid. They're the focus of Trump's ire. The U.S. president really honing in on issues like Japan's rice imports to Japan and auto imports to Japan, saying that they need to be taking more American products. Now, July 9th sounds soon in, I think, the world of Trump and negotiating. That's still a week away. A lot can happen. I don't expect us to know if the July 9th deadline gets extended until probably 24 hours or less beforehand. But it is the administration is clearly ramping up the pressure on Tokyo to try to get a better deal. With a lot of threats of 24%, 30%, 35% tariffs potentially hanging out there if they can't come to an agreement.
Well, Bill, in the meantime, we've got another deadline coming up. Of course, July 4th, Trump's self-imposed deadline for the big, beautiful bill. That's just passed through the Senate, just about. Now it heads to the House. Are there more hurdles ahead there?
Yeah, it may seem like Groundhog's Day, but yes, I think this bill has as many hurdles potentially in front of it as it did 24 or 48 hours ago. The Senate did manage to pass its legislation, so that is a win for the administration, but they made enough changes that the House has to reconsider it. And remember, they only have 3 votes to give in the Senate and the House to pass this bill. They've largely lost 2 of those members already, so it's down to one or two House members can really swing the vote on this. There's going to be a lot of fiscal conservatives on the House side who don't like the price tag of this bill that came through the Senate, which was beforehand was estimated at $500 billion more over 10 years. That's going to be very difficult to pass. I think we're going to be right up to the wire on July 4th. I would not be surprised to see this continue into the weekend without a final deal.
OK, Bloomberg's Bill Ferries, we thank you for that analysis. We have to see what the cost is for the Republicans in the midterms of all of those compromises, won't we? But let's get the market view now on all of this now with Nadia El Bilassi, senior analyst over at Equity Group. Really good to have you with me in the studio.
Likewise.
There's so much to think about, but what really struck me from your notes was that you're arguing US investors aren't pulling out of domestic equities to buy Europe. Those flows to Europe are because foreigners just aren't interested in the US as much anymore. They're saying no, thank you. I wonder, how much is that the reason for dollar weakness more than bets on Fed cuts?
Definitely. I think foreign investors are using Europe as a hedge right now to just pull out a little bit of U.S. stocks. They're still interested. I mean, the U.S. equities are still at multi-high levels, record highs since last week, backed up by, obviously, rate cuts, inflation levels that are kind of, somewhat elevated right now. So there's still a lot of things that are still backing up that U.S. equities, but also the fact that the euro is still higher. There's geopolitical events that happen that kind of stressed out investors and foreign investors in particular.
Yeah, so how much would the dollar have to weaken to get foreigners interested in buying America again?
I mean, so far it's just not being looked at as a safe haven asset, and that's why people are rotating into gold. But U.S. equities are still going and showing resilience unless there are going to be shocks into trade deals that we're going to see. I think that equities are just more fragile into seeing the shocks in terms of trade deals. As we saw today, any kind of decisions about trade deals, like, for example, Japan, directly the Nikkei, it went down.
Yeah, and we had that shock when Trump pulled the Canada talks off the table and then he put them back on again. But really, when we look at what these deals are going to be by July 9th, if we get them, they're really just MOUs. How much upside does that really create for US stocks?
I think that there was some sort of relief after we saw that there was a pause for the tariffs. And I think this has been putting a lot of, the rally has already started because of the cuts and the fact that there was a pause into the tariffs. But now that we have a deadline, I think things are a bit more edgy in the markets. I think that investors are a bit on edge, and that's why we're seeing a little bit of volatility. But I think that it's enough to sustain U.S. equities going higher. I think we should start to worry in Q4 when either negotiations go south or no deals have been made or any shock waves sent through the market in terms of any higher inflation, obviously, or not many cuts as expected.
Just going back to the Fed, we get, of course, that US jobs report on Thursday. Maybe we could get non-farm payrolls surprising to the downside. If that's a significant surprise, does it put a July Fed cut on the table?
I think that according to the SME tool, we already seen an uptick into polls yesterday by 23%. Just 2 days ago, they were 19%. So I think that, yes, markets are already pricing in a July cut. However, Scott Bessent, earlier this morning, he has mentioned that we're likely to see a cut by September. But this will also be backed up by the NFP, which is highly important, but also the unemployment rate, which is expected to increase economies. And I think that the more we see labor market suffering, I think this is going to give Powell a motive to cut rates as sooner as possible, because this is the goal, right, to have economic stability.
But if the Fed's cutting not because the trade risks to inflation have faded, but because the cracks in the labour market are showing, how much more momentum can that actually give US stocks?
I mean, both are giving enough momentum to U.S. stocks. I think the relief was necessary for U.S. equities to go higher, not just the cuts. I mean, that supported the rally last year in 2024, if we remember, just how many cuts we're going to have, and that's going to support economic growth. But also now we have spending bills that are going also out from Trump. That's also going to support equities, and that also supported equities last year is going to also have a mirrored effect this year as well. And also definitely that the fact that we're going to see cuts is definitely going to just give a relief to US equities.
All right.
For sure.
The optimistic view. Nadia El Balassi, Senior Market Analyst at Equity Group. It's lovely to have you with me around the desk.
Thank you.
Coming up on Horizons, the latest diplomatic developments in the Middle East. We'll bring you those next. This is Bloomberg. President Trump says Israel has agreed to the conditions needed for a 60-day Gaza ceasefire. Next, that plan will be presented to Hamas. It comes ahead of Israeli Prime Minister Benjamin Netanyahu's visit to the White House on Monday. So let's go now to Jerusalem and speak to Bloomberg's Dan Williams for more. Dan, welcome to the programme. Last time Hamas's counteroffer included a guarantee that Israeli troops would withdraw, which of course the US rejected. Is Hamas likely to demand the same terms again?
Well, from what we've heard from Hamas in recent days, and Hamas has actually been the least talkative of the three parties involved in these discussions, no, it would appear its conditions remain firm. Those conditions are, as you noted, for a full Israeli withdrawal, or actually, more precisely, an Israeli declaration that this war is over, with a full withdrawal of troops and tanks from the Gaza Strip. Effectively, Hamas wants a guarantee that once it delivers all the hostages it still holds, some 50 people, then it will be effectively provided immunity from an Israeli offensive designed from the outset to topple it from power and to disarm it. Now, Trump is hosting on Monday the Israeli Prime Minister Netanyahu. Monday will mark exactly the 21-month mark from the beginning of this war. It would seem an opportune time to declare the war over or ending, and it would appear the Israelis are at least moving toward a midpoint in the famous Witkoff offer, whereby half of the hostages would be freed by Hamas in exchange for a 60-day truce in which end-of-war conditions would be discussed. Hamas previously has said no, it wants to take an all-or-nothing deal, and it remains a big question whether now the Americans, perhaps via Qatar and Egypt, the mediators, will be able to convince Hamas to relent.
So, Dan, if we even get a ceasefire, what's to say that it would last when the last one, which ended in mid-March, didn't?
Well, again, a ceasefire will last. The previous ceasefires lasted. They ended actually as scheduled. And it's worth remembering that a ceasefire is, by definition, temporary. It's cold-eyed. It serves the interests of warring parties who are willing and able to return to war once they expire. So when Hamas talks about a permanent ceasefire, what it's basically saying is an end of war. What it's basically saying is the benefits of a peace deal with Israel, a party it will never actually make peace with. So I think it's worth distinguishing between the 60-day ceasefire proposed by Trump, which would be an interim period, and the end of war that all parties seek, albeit on very different terms.
OK, really crucial context. Bloomberg's Dan Williams out of Jerusalem. We thank you so much for that excellent reporting. Now, everybody wants to play peacemaker, it seems. While President Trump tries to end the war in Gaza, the French President, Emmanuel Macron, has been on the phone to Russian President Vladimir Putin for the first time, notably, since 2022, trying to coordinate the approach, this time on Iran. For more, let's bring in Stuart Livingston-Wallace, Bloomberg's executive editor for the Middle East, North Africa and Russia. Stuart, just talk us through why Russia would help persuade Iran to abandon its nuclear enrichment capacity when actually it helped to build it.
Well, it helps build one of the nuclear plants, which is something. No, the short answer is I don't see that there's anything in it for Russia at all on this one. Conceivably, maybe there's an economic argument that if they take over the enrichment process, then they become a joint provider with, say, France for enriched uranium to a civilian nuclear program. But it's a little bit of a stretch. I think what we saw here was two leaders grasping for relevance in this equation, because what happened a week ago when the US decided to bomb Iran had absolutely nothing to do with Russia or France. And so I think you've got Macron trying to reinsert himself into the Middle East. And fair enough, France has a long-standing interest. And Russia trying to reinsert itself as a global player. Because, again, it's become a pariah state. So that felt like the trade-off here more than any real sense that they're going to make any progress of persuading Iran to do anything.
Well, you kind of wonder what Macron even got out of that call. But meanwhile, the other player that Israel's trying to get involved here is China, trying to get it to use its economic and political heft to rein in Iran's nuclear and military ambitions. Is there any sign that Beijing wants to get involved in this and be a mediator?
None whatsoever. And I think it's a fundamental misunderstanding of how China views this relationship. So, yes, it is an important relationship. It buys a reasonable amount of oil and it gets at a discounted price. So from China's economy point of view, it's a jolly useful thing to do. But China has no interest, as far as we can tell, in involving itself in Middle East politics. And it's certainly got no interest in dictating to its trading partners how they should be behaving. So, no, it seems an entirely fruitless line to pursue.
OK. Bloomberg Executive Editor for Middle East, North Africa and Russia, Stuart Lewiston-Wallace, we thank you for that analysis. Now, the Trump administration is halting the transfer of artillery rounds and air defences to Ukraine. I mentioned the Macron-Putin call. Putin, of course, rejected any notion that he'd be accepting a ceasefire in Ukraine. And it's citing concerns about low US munitions stockpiles. The decision comes as Ukraine faces increased missile and drone attacks from Russia. It's seen as part of a broader US effort to reassess international military support and assistance. So, a lot of news on the geopolitical front, a lot for the market to digest. But coming up, giving X a whole new meaning. Donald Trump and Elon Musk are at each other's throats again. We're going to bring you the latest on the Tesla boss and his EV company next on Horizons. This is... Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. To tech now. As Elon Musk cranks up criticism of Donald Trump's tax and spend package, the president has threatened to cut the Tesla CEO's subsidies and deport him, all of which sent Tesla stock lower for a sixth straight day yesterday ahead of a key deliveries data release. For more, let's bring in our EV supply chain and aviation reporter, Danny Lee. Danny, good morning. As we know, Musk may be born in South Africa, but he's still got US citizenship. What's the latest in this Trump-Musk spat and really where it could leave Tesla?
Yeah, Lizzie, good morning. We have just had yet another round of Elon Musk amping up criticism of Donald Trump's policies, specifically around this big tax and spending bill that has been working its way through Washington. And as a result, Donald Trump has fired back. And there's just some of the comments which are so fascinating that he made so publicly that has caught the attention of Wall Street once again. And specifically, Donald Trump has criticised Musk over his own criticism and therefore has said that Musk is only unhappy because the bill going through Washington would significantly reduce how much subsidies Tesla gets. And that has been billions, Trump has pointed out, over many, many years. And as a result, it's just this kind of split between two of the most powerful people. And Trump went a bit further, saying he would also look at Musk's immigration status. And so therefore, it's just boiling over into this unknown between two very, very, very outspoken people.
And Danny, we know that Musk's involvement in the Trump administration's hurt his sales in Europe. I wonder how significant it is that now Musk has announced he's going to assume oversight of Tesla sales, not just in Europe, but also in the US.
Yeah, I think basically Elon Musk is just putting his money where his mouth is. After taking a step back from Doge, there was a lot of concern from investors around this flagging sales that Tesla has been experiencing in a lot of its key markets for many, many months. And so by taking charge of sales essentially in the key areas such as in Europe and in North America, therefore that leaves a bit of a reshuffle in the executive ranks after Omid Afshar, a key deputy to Elon Musk, has left. And so that means we see the likes of Tom Zhu, who is another key lieutenant to Musk, taking control of global manufacturing and the sales across Asia. But therefore, it's Musk who can really drill down into trying to revive a very disappointing set of sales figures over the last previous quarters. And this is where investors will really see whether the Musk magic can really work once again.
Well, speaking of which, Danny, we're also expecting this key deliveries data. Could we see more disappointment?
Based on the expectations of analysts, and including the consensus from the numbers that Bloomberg collect, we're expecting second quarter sales for Tesla to come in at 390,000 or thereabouts. That would represent a 12% drop year on year for the quarter. So these numbers will be closely watched, given that this will represent another decline. Although on the quarter from the previous quarter, they would represent a small rise. But still, there's been a lot of focus on what's been going on at Tesla with the executive departures, the slowing sales or the sales decline, and also just where Tesla sits now at the apex of politics in the US, and with the share price declining up to 7.7%. Or more overall in the US the day before, and then just recovering slightly. This sales picture could put more pressure on Tesla.
All right, Bloomberg's Danny Lee, we thank you for your coverage as we look ahead to that data. Good to have you on the programme. Well, that drop in Tesla shares yesterday on the Trump-Musk spat did contribute to Tesla stocks falling yesterday. It meant that the US stock rally lost steam. But this morning, the picture looking a little more optimistic. Futures pointing higher on both sides of the Atlantic. The S&P looking to gain 0.3% as things stand. If we look at the cross-asset picture, you've got the Treasury yield on the 10-year up 1 basis point at 4.24%. We keep an eye on the developments in Congress on the big, beautiful bill, but also we look ahead to that US jobs data tomorrow. Coming up on the programme, we're going to dive into the Middle East and its markets with Arkham Capital's Fadi Gendi. That's next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Deal or no deal, it doesn't matter. President Trump says he's sticking with the July 9th deadline for trade talks while threatening Japan with higher levies in a dispute over rice. And Fed Chair Jerome Powell's also talking tariffs, saying the Fed probably would have cut rates further this year were it not for Trump's trade policy. And Trump says Israel has accepted the conditions needed for a 60-day ceasefire in Gaza, warning Hamas to agree to the deal. It's just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai, in for Jomana Basechi. Welcome to the programme, everybody. Welcome to Wednesday. And we have seen a bit of a hit to Asian stocks already this morning because we're a week away from Donald Trump's tariff deadline, and he says there will be no extensions. But if you look at the transatlantic futures picture, actually things looking pretty positive on both sides of the pond. If you flip over to the cross-asset picture, we've got the 10-year yield at 4.24%. Of course, we watch the progress on Trump's tax and spend package. It's gone back to the House from the Senate. And attention now turns to that US jobs report earlier, as it will be tomorrow. We await what it does to Fed cut bets. That optimism on Fed cuts later in the year has powered gold higher for 2 straight sessions. It's up again today. We've got the pound in focus as well, also coming back to the fiscal, because Keir Starmer, the UK Prime Minister, has had to make a costly U-turn, another one, when it comes to his flagship welfare bill. But but really it's the gilt market open that you want to watch later on in the morning. And then I've got Brent in there as well. $67 a barrel is where we trade at the moment. So many competing headlines to digest when it comes to Gaza, when it comes to Iran. But we look ahead as well to that OPEC Plus meeting on Sunday and the prospect of another potential supply hike. But let's check in on how Asia markets are faring now with Avril Hong in Singapore. Avril, the Hong Kong dollar's in the spotlight today.
Certainly, after it touched the weekend of the permitted trading range, the Hong Kong Monetary Authority had to step in to intervene in defense of the currency peg, and we saw it buying up about $2.6 billion worth of the local currency. Now, all this just adds to the sense of the Hong Kong dollar being on a roller coaster ride, also intensifies the debate about the sustainability of the peg. If you recall back in May when the dollar slumped, the Hong Kong currency, we saw a sort of rush by investors into it. The Hong Kong Monetary Authority's response was to flood the system with liquidity, and that also left borrowing costs lower. There was a gap with the US that meant it was popular to fund carry trades, and given how this gap is expected to remain, that could mean continued pressure on the Hong Kong dollar. Just highlighting this as a way in which we're seeing the moves in the greenback affecting not just central banks, but currencies in the region as well. Lizzie.
OK, Avril Hong in Singapore, we thank you. I just want to bring you some breaking news now. We've seen HDB financial shares jumping 14% in Mumbai after the $1.5 billion IPO. It's going to start trading. It started trading, and this is the biggest IPO this year. It's attracted strong demand, as you can see, from investors. HDB, a unit of India's biggest private lender, it's been selling shares at 740 rupees a piece, the top of the marketed range. And this is the biggest IPO since Hyundai's India record $3.3 billion deal in October. It really comes as institutional share placements and listings are picking up after the lull that followed the blockbuster 2024. So definitely one to watch. Those gains pairing just a touch as we speak. But let's turn to markets now here in the Middle East. Credit in the region has recouped its losses, thankfully, following President Trump's so-called Liberation Day and the market meltdown that ensued in April. But with a backdrop of lower oil prices, the question is, where are the best opportunities? Joining us for that answer is Fadi Gendi, Fixed Income Portfolio Manager at Arqam Capital here in Dubai. Good to have you with me.
Thank you.
Thanks for stopping by. I want to start in Saudi Arabia because it's already come to the international bond market earlier this year, saying that it plans to cover the budget deficit with issuances. When you've got oil prices heading lower, do you think that it's going to have to resort to more issuance?
Definitely. We think that with lower oil prices, like you said, at $67 Brent, this is significantly below Saudi's fiscal break-even of 95, which puts pressure on the sovereign to issue. We do think they will come again to the market, and they will come again in size. But this will also be balanced by spending cuts to a degree, as well as some asset drawdowns. I think the sovereign will be very careful with how it approaches the bond market in order not to destabilize spreads.
Okay.
That said, we think that because of this risk of high borrowing, we have a preference for some of the other GCC sovereigns that have lower oil break-evens and have less need to borrow, the likes of Abu Dhabi and Qatar versus Saudi.
Okay, really interesting. What about in high yield?
In high yield, again, the story is about oil. So we have a preference for the oil importers over the exporters. So the likes of Morocco, which is an oil importing country, it is a potential rising star, so a rating upgrade candidate to IG, and it has taken positive steps on its fiscal front. So we have a preference for Morocco over the likes of Oman, and Oman over Bahrain. We think Bahrain in the high yield space is the weak link because of very high debt to GDP, interest bill, and exposure to oil as well, and large funding needs. Egypt is a credit we like in the high yield space. It is an oil importer, but at the same time, we think valuations now have compressed a lot for the Egypt Eurobonds. Spreads are tight versus Bahrain, Oman, Jordan. We think the play there is more on the local currency front, the EGP trade, where you still get exposure to Egypt, but at the same time, there's a 20% carry net of tax, and the country is doing right things.
What about Turkey? Because we just had this Turkish bond surge off the back of that court ruling that they could delay the case that could have unseated the main opposition leader. Is that just kind of kicking the can down the road when it comes to the market pain?
So we think with Turkey there is some domestic political noise. We saw that transpire back in March, and now that story is still unfolding. We do have some exposure there. We're careful about what we invested in Turkey, with preference for some of the better run banks, private sector banks, and some of the high-quality corporates. On the Turkish local currency side, it's also an idea or a trade that we like. We have that on, but we have to be careful with the headline risk in Turkey.
Well, yeah, that seems brave. What if down the line Özal's predecessor is reinstated? How much is that going to test investor confidence, your confidence?
Yes, so it will be a challenging time, and if that were to happen, I think that it could create further negative volatility in Turkey. But if you are in the carry trade and you're earning close to 40% yield, and the currency is already part of the central bank's disinflation process, I think you're well paid to take that risk. But we would not be adding duration in the Turkey trade. We would focus more on the short end of the curve.
If we can zoom out, in the region, we've kind of seen geopolitical tensions dissipating, hopefully. It means that traders are turning focus back towards more usual topics like the health of the US economy. We've got the jobs report coming tomorrow, early as it is. How much upside could we see for Treasuries if we see, well, off the back of the report?
So I think we would need, now that we have had a significant rally in Treasuries and the 10-years at 4.25, we would need to see a significantly weaker jobs data tomorrow versus expectations to push yields further down. If the jobs data is in line or stronger, we think that because we're now at the tight end of the range, we would expect Treasury yields to increase.
Okay.
But at the same time, if you have a weak data print, like you rightly said, the odds of a July cut would increase.
And just finally, what happens if the Fed chair is announced early and they're a dove to yields?
Yes, I think this will significantly steepen the Treasury curve. If he is a dove and he's a shadow chair, and the market starts to price in more rate cuts while inflation is still not under control, this might benefit the short end but hurt the long end of the Treasury curve.
One last question. Who'd be credible to the market?
I think Walker, yeah, he's a credible candidate, yes.
OK, Christopher Waller, you heard it here.
Yes.
Thank you so much. Fadi Gendi, Fixed Income Portfolio Manager at Arkham Capital. Good to see you.
Thank you very much.
Now, for a look at some of the other stories that we're following this morning, Wall Street's largest lenders have boosted their dividends after passing this year's Fed stress tests. The annual review showed that all examined banks would maintain enough capital to withstand a hypothetical economic downturn. The Fed made the stress tests easier to pass by softening some requirements and plans to make further changes to reduce volatility. Elsewhere, the UK government has abandoned its planned welfare reforms to avoid a historic defeat in Parliament. That now leaves a £5 billion fiscal hole to fill and damages Prime Minister Keir Starmer's authority. The U-turn came after widespread anger among Labour MPs who criticised the reforms as Dickensian and warned that they would hurt disabled people and plunge 150,000 people into poverty. Well, those are some of your top stories this morning. Next up on the programme, South Africa's Reserve Bank governor says that a review of the nation's inflation target is nearly complete. Details on what it could mean for markets coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. To one of our top interviews now. South African Reserve Bank Governor Lesetja Kganyago was speaking to Bloomberg's Francine Lacqua on the sidelines of the ECB Forum on Central Banking over in Sintra, Portugal. Take a listen.
When the framework was introduced, there was always an understanding that we are going to lower the target. We did lower the target, but there was a shock, and we made a big policy mistake by reverting to the old inflation target instead of explaining that we experienced a shock and that we will come back within the target. In 2020, the National Treasury launched a macro review, and part of that macro review included a revision of the monetary policy and the inflation target. And one of the recommendations was that the inflation target should be lowered to 3%. Since then, further work had been done between the Treasury and the South African Reserve Bank. Our teams had been working very hard. They are fine-tuning the final details, and they then make recommendation to the Minister and the governor. What is in no doubt is that our inflation target range is wide, it is too high, it is out of line with our peers, and we could only, if there's a revision, the revision can only be lower.
So, Governor, when are you expecting actually for that to be finalised and presented to the Finance Minister?
Well, the work is being done by the team. It should be very soon that is finalised. I think that it is important. We have impressed on the team. There is an opportunity right now of using, as I had said, opportunistic disinflation, and that the sooner we finalise that, the better.
Well, in fact, the rand crept higher off the back of those remarks. But let's get analysis now from our Chief Africa correspondent, Jennifer Zavasaja. Morning, Jen. Just give us your key takeaways from that interview, because you managed to watch it in full.
Yeah, Lizzie, listen, Kanyaho is always very entertaining to watch, but if we take a look at the rand, it had been under pressure for a few days, at least in South Africa. We were watching very closely because just a few days ago, there had been some concern around this government of national unity, which is, of course, this coalition government that had been intact for the first time in the 30 years of democracy in South Africa, potentially looking like it was going to fall apart because of what had been the opposition party potentially looking like that was going to crumble. So it had been, the rand had been under pressure. And so the fact that we did see the rand actually rallying off of Kanyaho's comments seems like investors now are looking like they're a bit more bullish on the trajectory of the South African economy. We know that some of the, at least some of the moves for the rand is because of some of the weakness that we did see in the dollar. But still, it looks like at least what we're seeing from the economy potentially is giving some signs of green shoots on what Kanyaho is suggesting, and specifically on what he said there. He said opportunistic disinflation, which is a key point there. He's talking about some of the disinflation that we have seen in South Africa. We have seen inflation starting to creep down. It's actually been anchoring. It's actually been below this target band that he was referring to there for about 8 consecutive months. And so it's seeming like potentially we will get this decision, as he was talking to Francine there, soon. And investors have been calling for a decision on this target band to be reduced for quite some time. So really, that was the key takeaway there. And potentially that could mean we see some actually even more positive direction for the South African economy, which many investors and analysts have been waiting for quite some time.
Well, Jen, just give us the context here. Why are investors so focused on this inflation targeting range?
You know, it's very fascinating, Lizzie. If you take a look at this full screen here right now, this 3 to 6%, it's actually been in place since the early 2000s. And as Kanyaho was just signaling there, it's actually quite wide. And not just that, it's actually not necessarily in line what we've been seeing from other global trading partners. And so many investors and analysts that we actually speak to not only point to the fact that it is quite wide, but also that the fact that it actually gives sort of a misconception about where inflation needs to be anchored. And as I was just alluding to there, over the past few months, we've seen inflation not just hovering below this targeting range, it's been below quite consecutively. So the question that many people are wondering is, why does this band even exist? Now, investors and analysts do point to the fact that when this was created in the early 2000s, it did create some stability for the macroeconomy. It did help to reduce a lot of the volatility that we were seeing. But at this point in time, is it still serving that purpose, or potentially is it creating a bit too wide of a range for this economy? And so, as Kanyaho was signaling there, we are waiting to get this review from the National Treasury and also the Reserve Bank, and going to see whether or not this will be in fact changed. But it's seeming like, at least if you take a look at some of the research papers and also even from the IMF and other reports that are out there, it's seeming like, at least at this point in time, if we take a look at the macro picture, this 3 to 6% range is way too high and is not in line with the global picture, so not really serving the South African economy at this point.
OK, Jennifer Zabasaja, it's so good to get your notes on that top interview. Jen is our chief Africa correspondent, and she's currently in London. But coming up on the programme, we're going to take you right back to Sintra and our blockbuster central bank panel with Powell, Lagarde, Bailey, Ueda and Rhee. We're going to go live to the ECB forum next on Horizons. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Now, all of the major central bank chiefs have highlighted a shared preference for patience amid heightened uncertainty. And that was during a panel at the ECB forum.
We are determined to continue to be data dependent, to decide meeting by meeting, and to not commit to any particular rate path.
We are going meeting by meeting. I mentioned how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve. But as I mentioned, a majority of us do feel that it will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
It will depend on the relative strength of the 3 inflation dynamics, and we need some more information to determine that.
We are going to have to see those come through, though. I mean, come through into prices. I think we've still got to see the evidence and prices. But that background context allows certainly me to say, look, I think the direction of interest rates continues to be downwards.
We cut our interest rate 100 BP from last October, and we will continue to be in an easing cycle given our growth rate. But recently, financial stability risk has been rising. So we are keeping an eye on this financial stability risk in deciding the pace and the timing of the further cuts.
No ties, laid-back vibes. For more, Francine Lacroix, anchor of The Pulse, joins us from Sintra, who, of course, hosted that panel. Fran, they were talking about rates there, but, of course, the backdrop is tariffs. What did the 5 central bankers have to say there?
Well, good morning, Lizzie. I have to say the vibe was really one of uncertainty. So we could point to the fact that all of these big central bankers have different monetary divergence paths. But actually, they were saying, look, we need to look at the data. We can't pre-commit to anything, even for the Fed in July, simply because there's too much uncertainty when it comes to oil prices, but also tariffs. We're also still in the middle of negotiations between the U.S. and many countries when it comes to July. Now, it was very clear that for Jay Powell, the chair of the Fed is waiting to see not only the effects of tariffs, which are expected to probably show up in inflation data in coming months, but also that's why they make it meeting by meeting decisions. He was also saying that they're ready to readjust whatever happens to tariff negotiations and the impact it has to inflation. They're ready to readjust how they speak to the markets. Now, what was telling for me is that, July is around the corner. We're July 2nd, and he did not rule out a rate cut as soon as this rate meeting July 29th, saying that the Fed has prepared to learn that if the impact of tariffs is higher or lower, or later or sooner than we expect, then they have to remain nimble. So again, there was a sense of caution out there because they're not really sure what the economy throws at them in the next couple of months.
And what about the Bank of England? How's Andrew Bailey positioning for the rest of the year? Because, of course, the UK is the one that's got a trade agreement.
Yeah, so again, it was interesting. So you have Fed, on one side, then you have the ECB, which, by contrast, seems to have, said that they actually had a victory lap against inflation. Yesterday, that CPI number came in at 2%. So Christine Lagarde is nearing her cycle, at the end of the cycle, and she's in a much better position. It felt like Andrew Bailey was really in the middle. He positioned the Bank of England somewhere between the Fed and the ECB. He also acknowledged softness, for example, in UK wages and activity, but really refused to pre-commit to anything in August and beyond. He did warn that there was some reduced rate sensitivity. Now, this is quite important because it does change a little bit of where he sees the end of the rating cycle. He also warned that this reduced rate sensitivity means policy may be less restrictive than thought. Again, we had a good conversation about the neutral rate, what that means on how they guide the markets, and what it means for the next couple of quarters. Again, very, very different to what we also heard heard from the Bank of Japan. They have a completely different outlook altogether because they're looking to raise rates. And then the Bank of Korea was interesting because he was the only central bank governor that also did not have a reserve currency. And so, of course, they're much more bounced around when it comes to the currency, given everything else that's going on.
OK, Francine Lacroix, thank you so much for bringing us that blockbuster central banking panel out of Sintra. Francine Lacroix on the ground for us in Portugal. Good to see you, Fran. Let's just check in on these markets in our last minute here. We're looking at the futures picture, actually pretty positive as we head towards the open. Futures pointing higher on both sides of the Atlantic, but in particular for Euro Stoxx 50 futures, despite this kind of escalatory language from Donald Trump saying that his tariff deadline is not going to be extended. It's just a week away, so we keep that in focus. And as we look at the bond space, we've got Treasury yields pretty steady as things stand on the 10-year up a basis point at 4.25, on the 5-year 3.84. As you can see on the screen there. But we do have to look ahead to that US jobs report tomorrow, of course, for maybe some more gains in treasuries. But that does it for Horizons Middle East and Africa. I'm Lizzie Burden in Dubai. Do stay with us for Daybreak Europe. Tom McKenzie will be bringing you all the latest, including a dive into the latest on UK politics, the woes for Keir Starmer, his fiscal headache after that another U-turn when it comes to his welfare policy. So do stay with us for all of that next.